Right, do you want to get started? All right. Well, hopefully everybody has joined us. Good morning. My name is Rick DeLugash. I'm a partner at Waldron H. Rand and Company, and I'm also joined by Tom Barrack, also a partner at Waldron Rand. Well, welcome to a webinar on the Corporate Transparency Act. Today, we have the pleasure of being joined by Brian Reilly, a partner in Partridge, Snow and Hahn, LLP's Corporate Practice Group. Brian concentrates his practice on transactional matters, including mergers and acquisitions and general corporate and real estate matters. He regularly acts as general outside counsel for clients, addressing their day-to-day business issues. In this role, he has been closely monitoring developments regarding the CTA, or the Corporate Transparency Act, so that he can advise business entities on their compliance obligations. The object of today's presentation is to help potential filers understand their obligations and arm you with the information necessary so you can prepare these filings online yourselves. We have invited Brian to help the audience understand how to comply with this act and to avoid costly penalties, and in some cases jail time, because there is potential for jail if you don't follow it. I assume that's in very extreme cases. We ask you to please keep your microphones muted and enter all questions in the chat. Be sure we'll save some time at the end where Brian, myself, or Tom can address any questions. For those of you who are wondering, this webinar is being recorded and will be available for distribution afterwards. Brian, welcome. I'll let you take the floor.
Yeah. Thank you, Rick. I'm happy to be here. We can start flipping through the presentation and get started. So if you don't mind going to the next slide, Sarah. And you already heard all about me, so I don't need to tell you again. Rick did a great job introducing me. So like Rick mentioned, for any questions that you might have, let's put them in the chat. I'm happy to answer questions live if it's about the content. So if I say something and you have a reaction of, hey, I didn't catch that, or I didn't understand it, drop it in the chat and I'll try to answer immediately. If it's more of a specific question in your business or your circumstance, I just ask you to save those to the end, but feel free to drop them in the chat. So I'm sure most of you who are attending this webinar, you're here because you at least have some familiarity with the Corporate Transparency Act. You've probably at least heard about what it is, and you've chosen to attend because you have questions about what it means and how you comply. So the Corporate Transparency Act goes back to the Anti-Money Laundering Act of 2020, and the stated purpose of the act is to prevent money laundering and other illicit activity. And Congress decided that the best way to do that was to implement beneficial ownership reporting requirements for essentially all business entities. So they estimated it's going to impact about 30 million business entities in the United States who will now have to complete a filing. There's additional guidance at FinCEN's website, which we'll talk about later, but high level, that's really the purpose, is they're trying to catch people who are using shell entities that might be up to no good. We can go to the next slide. So high level, I want to talk about who's required to report and what is required to be reported. And in this presentation, I'll give you the high level of those requirements. And then at the end, we're going to actually go through a sample BOI report using dummy information that I prepared in advance of this, so we can actually walk through what it looks like to prepare a real BOI report. So as far as the requirements, like I mentioned, essentially every business entity in the United States is potentially a reporting company. So a reporting company is any entity that's formed or created by filing with a Secretary of State or equivalent office. So whether it's Secretary of State, Secretary of the Commonwealth, that would capture essentially all corporations, LLCs, most other business entities. There are some exemptions to filing. So you could be a reporting company, but be eligible for one of the exemptions. The most likely one to apply is for large operating companies. So the CTA is a little unusual in that when you think of most regulations like this, they typically target the larger, more complex businesses that are out there. The CTA is kind of the opposite, where the presumption is that who they really want to target are the smaller potential shell entities. So generally speaking, the exemptions are available for highly regulated industries, and your run-of-the-mill mom and pop style business is not going to meet an exemption. So some of the exemptions are things like CPA firms, banks, pooled investment vehicles, broker dealers, other highly regulated industries. The large operating company exemption applies to any entity that has in excess of 20 employees, in excess of 5 million in gross receipts, and a US operating presence. And that's on an entity by entity basis. So if you're part of an organization that has, let's say 5 LLCs as part of one org, and each of those LLCs has, say, a handful of employees and in the aggregate exceeds 5 million, that's not the test. The test is each of those entities would have to have in excess of 20 employees and the $5 million in gross receipts. So it's an entity by entity test, and you're only exempt if the particular entity meets that test. So then the question becomes, if you're a reporting company and you are not eligible for an exemption, what are you required to report? And it's really 2 categories, technically 3 categories of information. So one will be certain information about the entity itself, and then it's information about your company applicants and your beneficial owners. Company applicants are essentially the people who are involved in forming the entity. So it can be up to 2 people. In many cases, it's only 1 person. So if you're a business owner that you went out, you went to the Secretary of State website, you filed to form a single member LLC, and you're the sole owner, you're the company applicant. You submitted that filing, you were the only person involved in submitting it. Other scenarios, let's say you use a service provider, so you work with a law firm or another service provider that assists you in the formation of that entity. In that scenario, there can be up to 2 company applicants. So it would be the person that actually submits the filing, if you do it online, the person that actually pressed the submit button, and then at least 1 other person that was involved in the filing. So an example would be, if I was forming an entity for a client and I was working with a paralegal to do that, and I tell the paralegal, yes, form the entity, and then they form it, I'm a company applicant alongside my paralegal that actually submitted it. So depending on the circumstances, you have to do some analysis as to who the company applicants are. The trickier piece is beneficial owners, which, as you'll see there, there's 2 categories, and that's either that you have a 25% ownership interest or you exercise substantial control over the entity. And we'll talk about each of those categories in a little more depth. So we can go to the next slide. So 25% ownership interest. On its face, you'd think this would be an easy analysis, and in many cases it is. So if you're a company where it's, say, 2 owners, you're each 50-50 owners, clearly the 2 of you each satisfy the 25% ownership interest requirement. You're the only owners. Clearly the 2 of you are beneficial owners. That's an easy analysis. Where it gets trickier is when you have complicated cap tables and rights that are equity-like, but maybe not immediately equity. So could be things like if there's stock options or convertible notes or other rights to acquire equity in the future, you have to take all of that into account. So if you have a complicated cap table and you have, for instance, multiple rounds of financings or convertible notes out there or other complicating factors, actually determining who has a 25% interest in the company can be more complicated. For most companies, though, that's going to be a straightforward analysis. We can go to the next slide. So then the other prong of the test is substantial control. And so going back to the purpose of the CTA, like I mentioned, the purpose is to capture or find money laundering or other illicit activity. And the concern is that in many of those criminal enterprises, you may have individuals that are in effect controlling the entity who on paper do not have any equity, or at least not substantial equity in the entity. So the substantial control prong is really designed to capture those people that are exercising control like an owner, even though they might not satisfy the 25% ownership requirement. And there's 4 categories of people that fall into the substantial control test. So one is individuals who are senior officers of the reporting company. So that would be your CEO, CFO, general counsel, roles along those lines. And it's not so much about title, but function, right? So it's really the senior people controlling the entity. And whether you call that a CEO or a president or some other title, for example, it's not the title that's dispositive. Second class would be anyone who has authority to appoint or remove the senior officers or a majority of the board. Anyone who directs, determines, or has substantial influence over important decisions made by the company. So again, if you have somebody that's a minority owner, but in connection with their ownership, they have the right to appoint all of the board. From FinCEN's perspective, that person exercises substantial control because in effect, they're controlling who controls the entity. And then finally, you've got to love this last category, which is, in essence, substantial control is substantial control. So it's a tautology, who knows what it means? We haven't got a lot of guidance, and it's intentionally vague. And really what that's intended to capture is scenarios where maybe a spouse forms an entity and owns 100% of that entity, but it's really their spouse that's calling the shots, right? So a husband owns 100%, but the wife is telling the husband what to do, or parents own the entity, but the children are telling them what to do. This is intended to capture that. So if there's some scenario where even though on paper somebody does not have ownership, they don't have control, they don't have any rights, if they are the ones behind the scenes pulling the strings, they're a beneficial owner from FinCEN's perspective. One thing I want to really highlight on the substantial control test that's going to trip people up is the senior officer piece. So most people, I think, reasonably don't think of something like hiring and firing a CEO or a CFO as implicating ownership of an entity, right? Often those folks are just in a job role. They don't own anything. So it's not apparent on its face that that's actually a change in beneficial owners, but the way the statute is written and the regs are written, that constitutes a change in beneficial owners that necessitates an amendment to your ownership information report. So you need to keep in mind, if you go out and your CFO leaves for a new job and you hire a new CFO, that necessitates an update to your BOI filing. So it's something to keep in mind. It's something that's going to trip people up, and I just wanted to particularly flag that. With that, we can go to the next slide. So then we get to what information has to be reported. So the company itself has to report its name and any DBA names, its business address, its jurisdiction of formation, and a unique identifying number like an EIN. You can also obtain FinCEN identifiers for the company itself or for either beneficial owners or company applicants who might be repeat filers, and I'll talk about that a little bit later. And the filing responsibility is ultimately on the company. So there can be liability for those who control the company if they willfully fail to report or willfully report wrong information, but ultimately the liability is the company's liability. It's responsible for making sure it files the report and that the information is accurate. So we can go to the next slide. So timing of filing. So for any entity formed prior to 2024, you have until the end of this year to file your BOI report. If you were formed in 2024, you have 90 days to file your BOI report. And if you're formed in 2025 or later, you'll have 30 days to file. So the thing that you have to pay the closest attention to right now is for brand newly formed entities, because those are the ones that will trigger the 90-day filing requirement. Likewise, if you have a change in beneficial owners, like I mentioned earlier, for example, you swap out a CEO or CFO, or you had somebody that went from being a 20% owner to a 25% owner, or 100% owner passes away and passes their interest to children, so they now exceed the 25% threshold. Each of those events would necessitate an amendment to the BOI report to reflect that the information has changed. Likewise, if you learn the information was inaccurate, you have to file within 30 days after learning of the inaccuracy. So for example, if you filed and said that a beneficial owner's birthday was January 1st, and then you come to realize actually it was January 10th, you have to go in and update that report to reflect the correct information within 30 days of learning of your error. And then, like Rick alluded to, there can be fairly significant penalties for failures to file. So there can be civil penalties of up to $500 per each day that a violation continues. There can also be criminal penalties, and those can be up to $10,000 in imprisonment for 2 years. FinCEN has been pretty clear in all of its guidance to date that at least for the first year or two or even longer, their efforts are going to be aimed at education more so than enforcement. So not to say that you should ignore your obligations or miss deadlines, but in particular for an entity that maybe in good faith didn't know about the obligation or didn't understand the obligation, FinCEN is not looking to immediately hit people with harsh penalties. Of course, if you're willfully misreporting or otherwise engaging in illegal activities, FinCEN's going to take issue with that. But like I said, they've been pretty clear that they're not looking to throw the book at people. And my assumption is really where this is going to come into play is almost similar to getting Al Capone on tax violations. It's going to be a scenario where they'll find somebody who was engaged in money laundering, then look back to see what entities they're affiliated with, determine that those entities didn't make a filing, and then use the CTA as a way to levy additional painful fines and penalties against that person that was engaged in illegal activity. So that's just my feeling how it's likely to pan out. That's not based on anything that FinCEN has said, but still, of course, anytime you're dealing with a federal law, it's important that you comply. And it is going to become relevant for many companies where you'll see it. For instance, if you're obtaining a loan, you might have a bank requesting a covenant that you have filed your CTA report and will file. You'll see this in all sorts of contexts. It'll be reps and warranties in M&A transactions, certain agreements, there might be reps and warranties. So beyond the penalties associated with violating the statute, there's potential for, breach of contract or breach of loan documents or other potential issues if you have covenants to file and you don't file in a timely manner. We can go to the next slide. So I did want to talk a little bit about the ongoing litigation involving the CTA. Some of you may be aware of it. Some of you may not be aware. There's more than one lawsuit, but the one that's really caught folks' attention is the case out of the Northern District of Alabama. And so I had a lot of outreach from folks saying, hey, this court found the CTA unconstitutional. That must mean I don't have to file. Unfortunately, that's not the case. So that holding in that case only applies to the plaintiffs in that case. There was an injunction issued, but it only benefits those plaintiffs. And it only benefits the plaintiffs that were parties to that suit or were members of the applicable organization as of a specific date. So you can't get sneaky and say, oh, well, I'll join this trade group to avoid a filing obligation. There has been an appeal of that decision. In all likelihood, it's going to be months, if not years, before the decision makes its way up to the Supreme Court, if the Supreme Court decides to issue a ruling. So for the time being, my advice that I've been giving to clients is you should still do your analysis whether you are a reporting company, whether you meet an exemption. If you don't meet an exemption, who your company applicants and beneficial owners are, and gather all of that information and begin the filing process. some of my clients are choosing to wait for a few months to see if anything changes, but at this point, given we're in June, it's election year, my feeling is the likelihood is that we're not apt to see Congress take any action. We're not apt to get any sort of legal decision that gives us real clarity. So for the vast majority of businesses, you're going to have to file because we're not going to have clarity by the end of the year or within that 90-day deadline from when you form an entity. We can go to the next slide. So then one of the things that Rick and Tom asked me to do, they thought would be very helpful, is sort of do a soup to nuts walk through what filing a beneficial ownership information report looks like. And I think what folks will probably be pleased to see is that it's actually fairly easy for most entities to do this on your own. If you're a typical, single member LLC, 2 members, 3 members, a simple S Corp or C Corp with limited owners, a BOI report is not overly burdensome to file. It takes some time, but it's actually fairly easy. And I have to give some credit to FinCEN. They made the portal fairly intuitive. So I'm going to now walk through a series of slides where we go through a fictional BOI report that I just populated with some dummy information just to walk through the process. One thing as we go through, I of course have to give the caveat that everything I say is not legal advice. It's just sort of high-level overview of the law and how it applies. And of course, people should talk to their own advisors, but I'm happy to sort of walk through what this looks like. And I think for a lot of folks, you'll be able to file on your own. So when we get to the BOI portal, you'll see that you can click through and you'll have the option to submit a BOI report. Going back to my reference earlier to obtaining a FinCEN ID, you can obtain a FinCEN ID from the same BOI portal where you file the actual BOI report. I'm not going to go through the process of obtaining a FinCEN ID, but I've gotten one for myself. It took me about 15 minutes. It's fairly easy to do through the portal. Generally speaking, the folks I'm recommending to get a FinCEN ID are people that would be either repeat company applicants or repeat beneficial owners. So if you own, for example, or have an interest in 20 different entities, it can be helpful to have a FinCEN identifier because now that's a single number that you can use in a filing in lieu of submitting all of your information on each filing. So again, if you are sort of a one-off, you have a single business, that's the only business you have an interest in, probably not worth it getting a FinCEN identifier. But if you're a professional that is either serving as company applicant repeatedly or has an interest in many entities, it may be in your interest to get a FinCEN identifier. So that was kind of an aside. As you go through the portal, you'll get to this page. You'll see there's 2 places you could click to proceed. It's either that Get Started button in the top right or the File BOIR in the bottom left. Either of those would take you through to the BOIR filing process. So that'll take you to a page that looks like this screen here. It gives you 2 options, which is File PDF BOIR or File Online BOIR. In almost all cases, you're going to choose the file online. The PDF version is essentially all of the same information. It allows you to download a fillable PDF form, which you could then print or save and upload. My experience is that the electronic portal is more streamlined and easier to use. Where the PDF can come in handy is, let's say, you want to put in all the information and then have somebody double check it, whether that's maybe your executive team or your legal advisor or somebody else. You could populate the PDF, send it to them, say, hey, does this look like I did it correctly? They can tell you yes or no, and then you could submit it. So that is where the PDF could have a benefit. But in almost all cases, you're going to click that Prepare and Submit BOIR button under the File Online option. So once you've done that, you'll actually get into the BOIR reporting portal itself. You'll see along the top, these terms should now look familiar to you. So reporting company, company applicant, beneficial owner. So you're just going to go through each of these tabs, populating the necessary information. One thing to keep in mind, and it does say this at the very top of the page there, is that the asterisks mark the information that is required. But unlike many forms where you can sort of just fill in the asterisk information and assume that if it's not an asterisk, you can skip it, that's not the case here. So the asterisk items are the absolute minimum that you have to provide. But to the extent any of the fields are applicable to your company, even if they aren't an asterisk, you should still be completing those fields. So the first thing you'll see when you log in is this filing information page. You're going to have to select one of these 4 options. If you have not yet filed an information report, what you're going to be selecting is initial report. This is your first report. If in the future you have filed a report and then you have a need to either correct information or update information previously provided, or you become exempt, you would select one of the other options. I'll touch for 1 minute on newly exempt entity. So what that would mean is, let's say, for example, under the large operating company exemption I talked about, at the time you were required to file, you did not meet that exemption, but now a year or 2 has gone by, your business has grown, you now exceed the 20 employee and $5 million threshold. You can then come in and update your report to say you're now an exempt entity. And then you don't have to do anything further unless you cease to be exempt. So in theory, if you have an entity that's hovering around those numbers, you could flip-flop between being exempt or non-exempt and have to update your report accordingly.
Brian, do you have to, if you now become exempt because you're over 5 million and 20 employees, do you have to go in and say affirmatively you're exempt, or just ignore it and not file going forward?
Yeah, so there's a little gray area there. So technically speaking, I think they would view that as a change that necessitates the update to the filing. Interestingly enough, if you determine at the outset that you are an exempt entity, there's no filing requirement. It's not like you have to log in and file to say you are exempt. It's only the scenario where you started non-exempt, submitted a filing, and then became exempt.
Okay.
One thing that I've suggested, though, if you make the determination that you're not filing because you're exempt, keep good records as to the analysis you did, right? So what you don't want is after the fact, when FinCEN is investigating, you're saying, oh, no, we didn't file because we're exempt. But from their perspective, they think you're just making that up because you didn't file on time. So you'd want some contemporaneous records saying, hey, we did an analysis and we fall into so-and-so exemption, for example, a large operating company, because we have more than 20 employees, more than 5 million in gross receipts, and we locate in the US, we're not filing the report, and put that in your file. So if ever there's a question, you can point out and say, yeah, look, we made a determination. We didn't just miss the deadline. And then you'll see that item 2 is just auto-filled. So I happened to prepare this presentation on June 10th, which is why it's filled in. If you were to log in today, it would show today's date. We can go to the next slide. So then the next tab is for reporting company. And now each of these tabs, when you log in, will be all on one page. I chopped it up just because to fit it on slides, we have to split it up, but all of the reporting company questions will be on one page that relates to the reporting company, for example. So boxes 3 and 4, you would check these if applicable. You can request a FinCEN ID for the entity. In all reality, the likelihood is you're not going to need it for much, but you can ask for it. At least then you get it. And then you'll see for items 5 and 6, you have to report the legal name and any DBA names of the entity. So here, like I said, it's just dummy info, ABC Corporation. If they were ABC Corporation operating as Brian Reilly Services, I would put Brian Reilly Services in box 6 because that's my DBA name. And if you have multiple DBAs, you can just add alternate name to list them all. And one thing I should have mentioned, actually, what you see throughout, there's these need help drop downs. We can't do it in the presentation, but on any of those fields, if you're not sure what they're asking for or you want more context, if you were to click that drop down, it would give you additional further helpful context on how you respond to that particular question. So again, if we're continuing through the report, the next questions 7, 8, and 9 relate to your identifying information, your identifying number. So for almost all US entities, that number is going to be your EIN. If you were a foreign entity, it would be whatever is your equivalent of an EIN in that foreign jurisdiction. But for the vast majority, it's going to be an EIN. Again, I just plugged in a dummy number, 1111111. And you don't have to fill in box 9 unless it's a foreign ID of some sort. So it's presumed that you're a US entity unless you indicate otherwise. So then we get to the information on the domestic reporting company. So you have to indicate the state of formation. If you were not formed in a US state, if you were formed in a tribal jurisdiction, you would list that. But for the vast majority of folks, the drop downs here are going to be that you're formed in the United States of America and the state that you were originally formed in. One place, not that this gets tricky, but something to keep in mind is, for instance, if you are a Delaware LLC that qualifies to do business in Massachusetts, for purposes of your report, your answer would be that you're a Delaware LLC. And you don't have to file separate reports, saying one is Delaware and you're also qualified in Mass. You just file the one report, and in that you report the jurisdiction where the entity was originally formed as a domestic entity. So then for the address, again, pretty straightforward. You will want to insert your primary or principal business address. Typically, that's going to be the same as the address that's on your certificate of formation or articles of organization. But if you have multiple addresses, you're not listing all of the addresses. You're listing the principal business address from which the entity operates. And again, this is just dummy information for purposes of the sample. So then we get to the company applicants. So once you finish that previous tab of the reporting company, that's all the information you have to report about your company itself. Next step is company applicants. You'll see that box 16. If you're an existing reporting company, which means you existed prior to January 1, 2024, you just check this box and you don't have to report any information on your company applicants. That's because FinCEN, wisely in my opinion, realized that it didn't make sense if you've got an entity that's 5, 10, 15, 20 years old to require you to go back and figure out, all right, well, who was the attorney that formed that entity, and then gather information from them. So the idea is if it was formed pre-2024, you just note that you're an existing reporting company and you're done with this tab. If you're formed on January 1, 2024 or later, you do have to report who your company applicants are. Now, I already explained earlier who that would be. It's the people that actually form the entity. If those people have a FinCEN identifier, the only information you have to provide for each of them is that box 18 FinCEN ID. So just as an example, if I form an entity for a client, once the entity's formed, I send them an email. I say, congratulations, your business has been formed. So-and-so LLC is on record as of so-and-so date. You are now obligated to file your BOI report within 90 days. And here is my FinCEN ID so that you can report me as a company applicant who formed your entity. And I'll provide that to the client. When they go to fill out their BOI report, all they have to do is plug that number into box 18 for me, and they're done as it relates to me. If the company applicant doesn't have a FinCEN ID, then you have to gather certain information from them and report that information, which we'll talk about on the next slide. So the information that has to be reported is your name, address, birth date, and then the number off an identifying document and a copy of that document, which should be either a driver's license or a passport. So for the address, if you're working with somebody who is a service provider, so a law firm, either attorneys or paralegals, or a corporate service company of some sort, you would insert a business address for them. And we can go to the next slide for that. Yeah. So you're going to select business address and stick that in. If it's anything else, if it's an individual, so if you formed your own entity, John Smith goes to the Secretary of State, forms a business entity of which John Smith is the sole owner. In that case, you're using your residential address. You only use a business address if it's a service provider who is the company applicant. And again, it's fairly straightforward. You just insert the address, and then you go to the next slide where it'll give you the option to insert the information on their identifying document and to upload a copy of that document. So as you can imagine, I obtained a FinCEN ID because I don't want to be in a position of sending folks copies of my passport and driver's license so that they can complete a BOI filing. It's much more, it's preferable for me that I can just provide a simple number and they can insert it and be done with my information. But for folks who you do need the info, you'd need them to scan you a copy of their driver's license or passport. You'd insert the document number. Here I just did XXXXX as a random number. And then at the bottom there, you have the option to upload a file. So you would upload a scan of that document. Overall, I found this to work well. I have had some people have problems with the actual upload where it can be a little picky about file type and things like that. So that is the one piece of the process where it can be a little persnickety, but overall, I've not seen a lot of issues with this. So once you do that, like I mentioned, there can be up to 2 company applicants. So if there was only one, you would go through that process once. If there were 2, you would just do that process twice, one for each applicant. On your beneficial owner, it looks a lot the same. By the same token, if that beneficial owner has a FinCEN identifier, you would just plug that in and you're done. If not, it's essentially the same process you just went through for the company applicant. You're going through that same process for the beneficial owner. And of course, if there's more than one beneficial owner, you would just click the button that says add beneficial owner in the upper right. If you have 3, 4, 5, whatever the number is, you just continuously add them, and then you can populate the information for each person. So if we go to the next slide, you'll see it looks very much the same as the company applicant information. There's one unique circumstance. So generally speaking, beneficial owners are always going to be natural people, actual human beings. The one unique circumstance where that's not the case is where the beneficial owner is itself an exempt entity. So in that case, you would click the exempt entity box and you would provide the entity's information. The idea being, if that entity has no filing requirements, then you wouldn't have to go beyond that entity for purposes of your report. But otherwise, the assumption is that the information you're providing should be the information of natural human beings. So then again, for the address, you're going to choose a residential address. And then very similar to the company applicant, when you get to this page, you're going to upload either a driver's license or passport for ID. There can be other forms of ID. For instance, I don't know if anybody on this call would apply, but if you were a member of a Native American tribe, your tribal ID could apply, for example. So the most likely are your passport and driver's license, but there can be other acceptable options. And then same thing, you're going to put that information in, scan the document, and upload it by clicking the link. So then once you do that, you'll get to your submission page. You'll have to put in the information of the person who's actually submitting the report. So of course, it's just email, confirming the email, name, last name, and then you're certifying that the information is correct, right? So if you look at the very last asterisk there, you're being asked to check a box, and by checking that, you're certifying that you were authorized to file the report on behalf of the company, and that all of the information is true, correct, and complete. So for that reason, my experience is that most service providers are not willing to actually file the BOI report on behalf of a company. That's where my firm is netting out. We'll help you determine if you're a reporting company, determine if an exemption applies, determine who the company applicants are, who the beneficial owners are, gather all of the necessary information. But when it comes time to actually submit the report and certify that it's true, our position is that somebody at the company should be the person to do that, because ultimately they're the ones in a position to know that they actually have listed all the true and correct information. So you would, assuming you double checked and everything looks good, you would click I agree. And then you would move to the next page, which again has you this reminder of your obligations. You have to select that you are a human, and then you submit. Once you submit, what you will receive is an email indicating a reference number and that the report has been submitted. But in my experience, it doesn't actually provide you a copy of what was submitted. So to the extent you want any copy, you're either going to want to print or take screen grabs of what you've prepared before you submit it, because once you do submit, you're not going to get that final copy emailed to you. So that's really it. And then high level, if you have multiple business entities, you would just do that same process for each entity, making the determination if a filing is required, and then who the company applicants are, who the beneficial owners are, and go through that process. So for the average, single member, couple of member type entity, it's maybe a 10 or 15-minute exercise. Once you've got all the information that's required in hand, it's relatively straightforward to actually do that filing, and most folks can do it on their own. So with that, happy to open it up for questions, and I hope it was helpful.
Hey, Brian, before we hop into the chat, I had 2 questions that I think are going to be relevant, or maybe a lot of people might be thinking. So just getting out ahead of that. If you have a multi-member LLC, for example, and one of the members of that LLC was also a multi-member LLC, what do you do in that situation?
Sure. Yeah, so it always goes back to the ownership test and the substantial control test. So first question is ownership. So does that multi-member LLC, what percentage does it own? And then ultimately, what percentage of that LLC do its ultimate owners own? So to put that another way, going back to what I said earlier, you're always looking to the final actual human beings that own the company. So if you had an LLC of which you have a member that owns, let's say, 50% of that LLC, that's the first step of the analysis, but it's not dispositive on its own, because you would then go up to the higher level LLC and say, what do those members own? So if you think about a LLC with a 50% owner, if that LLC has, let's say, 10 owners, in effect, they each own 5% of the underlying entity. And my position would be, based on the ownership test, no one of them exceeds the 25% indirect ownership of the underlying entity.
Brian, is there any attribution among parents, kids, siblings, that type of thing, which normally you have throughout the tax law?
Yeah, so that I think would be more under the substantial control piece, which is, I think, arguably, if you had a group of family members who together controlled a controlling interest, there could be an argument that, in effect, that group of individuals exercises substantial control because they're in some way so intertwined that they effectively control the entity. I think that really is the last prong of the substantial control test, which is sort of what's the reality, right? If they're always voting as a block and in effect control it, even though no one does, I'd probably hedge on the side of reporting them all as beneficial. But if they're truly separate, right? Sometimes you have kids and parents that disagree about everything. And in that position, I think I might say, look, they're not, in reality, they're completely separate. So I think that's a really factual inquiry.
Okay.
And then so just going back to Tom's question, the other analysis is substantial control. So if each of those 10 owners, even though they only exercise, say, 5% indirect ownership, was a manager of that higher level entity, and that entity was the manager of the LLC that's at the lower level, you might still have a substantial control argument of, well, they control the management of the higher level entity. So independent of their ownership, they're essentially in control of that lower level entity. So It becomes a factual analysis, but the answer is you're always going to the ownership and substantial control question. And if somebody you think satisfies either of those tests, hedge on the side of reporting them as a beneficial owner.
Got it. I'm gonna control the chat if that would be best. I'm just temporarily skipping the first question. I just want to answer Charlotte's question. Yes, Charlotte, LLCs need to file. Trusts, Brian and I talked about this yesterday. Trusts, for the most part, many trusts probably won't need to file as an entity because they're not registered with, the Secretary of the State or anything like that. However, it may be that some of the trust's beneficiaries are beneficial owners when you do that analysis. So hopefully that helps to answer that question for you. We have a question.
Yeah, just to clarify, where you tend to see this is the trust itself might not have to file, but if that trust, for instance, is the sole member of an LLC that owns an asset, the LLC has a filing obligation, which then may require the LLC to report information about the trust, because now either the trustee or beneficiaries of that trust might be beneficial owners. But the trust itself likely doesn't have a reporting obligation.
Perfect. Thanks, Brian. If the beneficial owner is a board of directors and no one director has control, would this be an exempt entity?
So I've run into this in really two scenarios. One is it's either a nonprofit, the other is a co-op type situation. And it's sort of a gray area. So merely being a board member is not inherently substantial control, right? If Congress wanted to, they could have easily said that service as a board member in and of itself constitutes substantial control, and they did not say that. But of course, there is the prong of the test, which is for people who exercise authority over substantial decision-making. And I think in a scenario where, for instance, a co-op has a board of directors who essentially control everything because no one owner, you might have 100 owners who each technically only own 1% of the entity. None of them satisfy the ownership test. They probably don't have any formal control, so they don't satisfy the control test. I think in that scenario, I would hedge on the side of saying that at the very least, the chairman of the board or the officers exercise substantial control, and probably that all of the members of the board do. But of course, that's really based on the specific facts and how things are decided under the operating docs. The other scenario, that I've seen where you might have that type of ownership is a nonprofit. There is an exemption for nonprofits. However, to have that exemption, it's not just that you're formed as a nonprofit corporation, it's also that you have a 501c status. So you have to be either tax exempt or religiously exempt to be exempt. So that would be the other scenario where it could be it's controlled only by a board. There's no actual owners and you meet the exemption as a nonprofit, you wouldn't have to file.
Got it. Thank you. Next question from Tom Saldini. I believe hopefully our previous questions covered this, but if an LLC owner is a revocable trust, are the beneficial owners all the trustees? I think, Brian, when we talked about this, we said clearly the trustee would be a beneficial owner just because of the fact that they have control. And then you would also continue to look through to the beneficiaries as well to see if they're required to report.
Yeah, so there is some guidance on this point in the FAQ that's on FinCEN's website. So I would suggest taking a look at the specific guidance, but the gist of that guidance is merely being a beneficiary doesn't necessarily make you a beneficial owner. For instance, if you're a purely passive beneficiary, but certainly if the trust document gives the beneficiary rights to appoint or remove trustees or to cause disbursements to be made from the trust, other things along those lines, then you're more apt to be in a scenario where they would say that person is a beneficial owner because they're now exercising substantial control over the trust operations.
Okay.
So again, Brian, you're looking through the trust to the ultimate beneficial owner is the one that has the right to remove the trustee. They're the ones who would have to file or be included.
That's right. And again, the trust itself only would have to file if it's a trust that's created by a filing with the Secretary of State or equivalent. Certain types of trusts are, you think of a Delaware statutory trust, for example, like there can be scenarios where a trust is formed by a filing, but many trusts are not, right? Many just exist as a creature of contract between parties, and it's not a formal filing that's taken place with the Secretary of State.
Hey, Brian, what about a realty trust going back years ago when, which were formed to own properties? They are recorded.
Yeah, so in my mind, there's some question in the regs when it says or a similar office in reference to a Secretary of State, whether it means similar office as in Secretary of State versus Secretary of Commonwealth, or similar office in the sense of a government agency. My reading of it is what it's really meant to gather is entities formed with a Secretary of State or the equivalent agency.
Okay.
So my reading of it is that an entity formed by a filing with a registry of deeds is not the type of entity that they're trying to grab. But I don't know that that's 100% clear. I've not looked super deeply at that question, but that's my reading of it.
Next question, can anyone get a FinCEN number?
Yep, anybody can go in and get a FinCEN ID. It's basically what you're providing them is the same information you would give as a company applicant or as a beneficial owner. So your name, address, birth date, and copy of your identifying document. And in effect, what's happening is when you input that FinCEN ID, it's referencing back to the information you provided when you obtained your FinCEN ID. So in effect, it's the same as having given all that information. One thing to keep in mind is if you get a FinCEN ID, then you have a duty to keep that information updated. So if you, for instance, change your address, you need to go in and update your FinCEN identifier information so that it references the correct address.
Got it. But it could be helpful if you didn't want to have to provide, say you had to be reported many times over and you don't want to have to be handing out your date of birth and driver's license, a copy of your driver's license, it can be helpful, right?
Exactly. I mean, that's why I did it. I think I forget the exact time, but I think within like 2 days after the portal opened, I applied for one because I knew I was going to be helping people form entities. And I also knew I didn't want to be in a position of sending copies of my driver's license or passport to people to have them complete filing. Got it.
And this question is somewhat specific, so hopefully you can answer it because I don't know the answer. From Tess, if you are an existing company and check box 16, which I assume is the box I'm an existing company, then the information in boxes 19 through 23 is not completed, correct?
Yeah, so I think what you're talking about there is the company applicant.
The company applicant information, I think is, yeah.
Right, yeah. So if you exist prior to 2024, by checking that box, you've answered the question on company applicant. So that's right.
And,
there's no
that's to perpetuity, right, Brian? That's not just for this current year's filings.
That's right. Yeah, and so this is a one-off filing. Unless something changes, it's not like you have to go in annually and do something. You only have to go in and do a new filing if information that you reported has changed. So you've moved addresses or your beneficial owners change, something has happened. You can become exempt when you weren't before. But if you're just chugging along, you're a single member LLC, you're the sole owner, you're living in the same place, nothing is changing, then there's no need to go in and file a new report every year.
Brian, what happens if you terminate the entity? You sell the real estate, whatever it may be, you're done. Do you have to go in and formally say, I don't exist anymore?
Yeah, so there is an exemption for certain types of defunct entities. So I've not seen guidance on that point, but I think the argument would be that at the point you've now wound up operations and dissolved. Well, I guess if you dissolve, technically that probably would be sufficient in itself because now the entity doesn't exist. But if it's a scenario where, we've seen it where it's an entity that hasn't been used in, say, 5 years, it's not doing anything, but it still technically exists. You might need an exemption, but you're not, unless you meet the exemption, you'd still have to file. I'm not sure that there's been formal guidance on whether there's an actual reporting obligation to tell FinCEN that you dissolved your entity. I haven't run into that yet.
Brian, to go back, I know you mentioned your firm and their posture. I mean, I want to emphasize that that is also our posture at this point, that companies should do this on their own. They don't need us to do it. And honestly, we're not sure if even legally as a CPA, we're allowed to do it. There's some debate on the Master side and the ACPA as to whether we're eligible to be a submit. And not to mention economically, it makes more sense for everybody to do this on their own. It's online. It's not like we're filing a form. So that's also our posture as well. We will definitely help if we can determine what the filing requirements are the best we can, or advise you to talk to Brian if it gets beyond our scope. But that is our position as well at this point. I don't know, Tom, do you have anything to add on that? I know we've talked
No,
about
I was just saying, to the extent that things are complicated, I guess that's one thing, but I would assume that probably in 80 to 90% of cases, it's going to be as simple as Brian said. You have one owner, a couple owners, whatever the case may be. Even if you have 30, 40 entities and you have the same two owners, is it a pain to do? Yes, but once you have the information that you need, it would probably be best just to chug through and do them all. And to the extent that you have a complicated structure, say for example, you have 60 partners in a entity, and some of the partners are multi-member LLCs. That might be something you might want to correspond with your legal team about, so that you make sure you're filling this out properly. Unfortunately, it's not as simple as just filing an annual report. So
yeah. And one other thing to add to that is, from a practical standpoint, everybody just wants to sit down and make sure you're covering all the LLCs that you have. You may not. There could be an LLC that owns an LLC, one that owns a property, and then there's 4 layers of LLCs. Each one is reporting entities. So everybody should just go through and make sure, ultimately at the end of the day, you file for all of the entities that you control. It's very easy to miss them because tax-wise, they don't matter. But when you look at the legal structure, there could be 4 LLCs in between the partnership and the underlying property, or business for that matter. So just keep that in mind.
Yep.
Oh, and one other thing for the large operating, I just want to clarify, large operating business, that's not in either 20 employees or 5 million. I believe it's 20 employees, 5 million in the prior year's tax return, and a physical presence. So you're not, which seems to be a physical office. So it's all 3 of those requirements to meet that exemption.
That's right.
And again, if you
on an
meet it
NC
1 year and then don't meet it the next year, you then have to qualify.
That's right.
I think that's all we have for questions. There's nothing else in the chat that we didn't answer. So thank you very much, Brian. Super helpful. And as we said to everybody, this has been recorded and we will distribute this. I think having the access to the walking through the slides certainly lets everyone know what information that they're going to need. So I think that this has been fantastic, and thank you for your time.
Yeah, thanks for having me. I was happy to do it, and I hope everybody found it to be helpful. And I hope everybody, when you go to do it, you find it's as easy as it looked today.
All right.
Thank you.
Thank you.
Thanks, everybody.
Thanks, Jess. Bye-bye.